And let's see. There we go. Wow. This is Apple SMA crossover. Strategy return beats buy and hold for Tesla. This is one thing. What's up, everyone? This is Dr. Tate from Quant. Welcome back to our algorithmic quant trading series. In our last episode, do you remember we successfully performed our first basic backtest of SMA crossover strategy? We calculated and visualized the cumulative return, comparing our strategy's performance against a simple buy and hold benchmark. That was a huge step. However, a single line on a chart or a final cumulative return percentage doesn't tell the whole story. To truly understand and evaluate a trading strategy, we need to deep dive into its performance evaluation metrics. This is crucial for assessing not just profitability, but also the risk, the consistency of returns, and how well it utilizes its capital. So today, we will learn how to calculate and interpret the most important performance metrics for our SMA crossover strategy. Okay, let's move on. So why are performance metrics so important? Imagine two strategies. Let's say plan A returns 50% but has wild swings, including a period where it lost 70% of its capital. Plan B returns 30% but had very smooth equity growth with a maximum loss of only 10%. Which one would you prefer? Most likely plan B, the strategy B, even though its overall return is lower. Performance metrics helps us quantify these nuances of risk and return. Let's head back to our Colab notebook. We will continue from where we left off, ensuring our AAPL underbar DF. The data frame contains the close price, SMA 20 days, 50 days, signals, position, daily return, strategy daily return, cumulative strategy return, and cumulative buy and hold returns column. Okay, I wrote all the codes for you. As you see, all you have to do is just shift enter. Okay, shift enter here. And it will show you the results. We start with Apple, ended with Tesla. Let's do with the Tesla this time. Some of you who missed it last episode, if you go back to, okay, I can use this folder tree here. Oh, not this one. If you go to here, episode 5, as you see, the ticker is a Tesla. Let's do Apple this time, AAPL. And shift to enter, enter, hit that enter, okay? And you get the numbers here. Returns. Total strategy return 97%. Buy and hold return 186%. Annualized strategy return 13. Annualized buy and hold 21. That was the result. Now let's move on to the next, which is volatility, standard deviation of returns. Volatility measures the degree of variation of a trading price series over time. In simple terms, it tells us how much the returns fluctuated. A higher volatility means higher risk. We will annualize this too, typically by multiplying the daily standard deviation by the square root of the number of trading days in a year. You don't really need to remember all those formulas, but just get the concept. It's a standard deviation within a year. So I wrote the code here already for you. So STD is a standard deviation. So all the Python and pandas will work for you. Okay, panda will work for you. So hit the shift enter, you'll get the result. Annualized strategy volatility is a 20.885%. Annualized buy and hold volatility is 32.53%. Volatility metric for Apple, right? This is cool, but still buy and hold beats our strategy, right, on Apple. So next one, you got to remember this very most famous ratio, the Sharpe Ratio. It is one of the most widely used risk-adjusted performance. It's basically annualized return minus risk-free rate divided by annualized volatility. It measures the excess return per unit of total risk. Again, excess return, okay? So higher Sharpe ratio is a better risk-adjusted return. So let's say the risk-free rate is, let's say, just 2% or 1%. We assume that. You can get actual numbers from the bond market, the treasury bill, treasury note. They have those risk-free information, interest rates. So calculate Sharpe ratios here. I used the formula, and let's hit the shift enter here. Our strategy, the SMA crossover, has Sharpe ratio of 0.54. Buy and hold Sharpe ratio has 0.59. Very close. That's neat, I think. We are getting less profits, but approximately great Sharpe ratio. That's impressive thing. And the fourth metric I'd like to introduce is MDD, Maximum Drawdown. MDD is the largest percentage drop from a peak in equity to subsequent trough before a new peak is achieved. It represents the largest historical loss an investor would have endured if they had bought at the peak and sold at the absolute bottom of that decline. This is a critical measure of pain. How much pain can you endure, basically, or on downside risk? So I wrote the code here and the explanation here on footnote. So here, cumulative returns, rolling max, drawdown, and minimum, and buy and hold. I calculate all of these. You can just take these codes and then run it. And you can switch around with your own stock, right? And let's see. There we go. Wow. This is Apple. You see those blue line is for the buy and hold the drawdowns. So if you buy Apple, but unfortunately if you bought that on the peak of the price, you have to go like deeper and deeper and deeper. But if you follow our strategy, your risk was just minus 0.1 here, this level. But if you were on a buy and hold, you were in panic. See this, how deep is this? So it has always a trade-offs, right? That's why I wanted to give you some quick idea and feeling about this MDD. So you gotta always remember those metrics to fully understand the profitability, risk, and risk-adjusted returns. Let's do another stock for fun. Let me do the Tesla. And here, short window, this is my favorite numbers, 822. And let's do this. Shift enter, 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 enter. Oh, it's not working. Let's start from the beginning here. There we go. SMA crossover. Strategy return. Beats buy and hold for Tesla. This is one thing that I would like to share. See, just buying and hold doesn't really guarantee anything. You gotta just move and move. Tesla SMA 822 crossover strategy beats buy and hold. See, let's check our performance evaluation here. So annualized even return beats but buy and hold by approximately 30%. Woohoo, let's go. Volatility, test, buy and hold strategy. Our benchmark is way more, 67%. What about Sharpe ratio? We have better Sharpe ratio, 1.36. That's so cool. What about MDD? Strategy, we gotta endure minus 44%. But if you buy and hold the Tesla, it will minus 73%. Oh my God, you're going to hell, whatever. Sorry. So see, you get the idea. You gotta move and move, change the numbers and periods, and you gotta think about your own strategy. This is one thing I'd like to really share. I was lucky. I mean, 822 is just my favorite number for trading. So I can give you some homework this time. Rerun entire backtesting and performance evaluation. Create a maybe small table and write that down, the annualized return, Sharpe ratio, maximum drawdown, those things. And reflect and think about it. Is this working? Do we have too longer period? We can just adjust the period to just within a year. Now I'm taking like 5 years, right? From 2020 to 2025. So, gotta do your homework. Do not just watch this video and, oh, well, that's nice. No, don't do that. You gotta do on hands-on. Get your hands dirty, okay? So, if you have any questions about these metrics or your result, drop them in the comments below. As I mentioned, don't forget to like this video, subscribe to Quant channel, and hit that notification bell so you don't miss our next deep dive videos. This is Dr. Tay from Quant. Peace.